All right, we're gonna try and get going so we can stay on task. We got a number of things to cover today. Some of it gets into some detail. Try and write down questions that you have, if you can, just as a show of hands so we understand kind of the audience makeup here. How many people were just in the last session where we talked about holistic risk management? Okay, so it looks like we definitely have some new people. So I'm going to have to, I'll do a little overview of what we talked about, and I'm going to apologize. I'm going to have to, for compliance purposes, and just because it's important to know, I do have to read over the risk disclaimers. This is the best part. You guys all know it. All right, so feel free to get a little excitement going. So the agenda today, we're going to just quickly talk about crop marketing and hedging review. We're just going to talk about some of those core principles, and I'll just kind of brush by them because we just went into detail on it. Then we're going to talk about insurance strategies with Eric, and then we're going to go into some more brokerage strategies with Josh McClure. So without further ado, these are our speakers. We've already introduced them in the last episode. Eric Sorensen is the Director of Crop Insurance, and Josh McClure, Senior Risk Management Advisor with FBN. The insurance disclaimer. And I'm doing this one for you, Eric. All right. Yeah, no, I'm excited. So here we go. So we are an equal opportunity provider. The purpose of the following material is to promote awareness of risk management concepts and to highlight risk management product features, benefits, and availability. This presentation does not provide full details of policy provisions or approved procedures. Producers should consult with a local agent or specific details on program requirements. On to the brokerage disclaimer. So commodity trading, including futures, hedging, and speculating, involves substantial risk of loss and may not be suitable for all investors. Past performance is not necessarily indicative of future results. All information, publications, and reports, including this specific material, used and distributed by FBN-BR LLC shall be construed as solicitation. FBN-BR LLC does not distribute research reports, employ research analysts, or maintain a research department as defined in CFTC Regulation 1.71, and that the views and opinions are solely those of the author as of the date of the publication. They are subject to change at any time due to market and economic conditions, will not be updated or supplemented after this date, and may not necessarily come to pass. The views and opinions expressed herein do not reflect those of all personnel at FBN-BR LLC or the views of Farmers Business Network, Inc. as a whole. Any charts, graphs provided for illustrative purposes only. Any performance quoted any performance quoted represents past performance. Past performance does not guarantee future results. Commodity trading, including futures, hedging, and speculating, involves substantial risk of loss and is not suitable for all investors. Got through it. It's real, so you guys can review that later. We're going to go over the crop marketing hedging principles that we just covered. So we want something to be systematic and repeatable. We want to do that because it is very difficult to improve if we're using our gut. How do you evaluate it? How do you quantify it? How do you improve from it? So you want something systematic and repeatable. That means ideally you want to write it down so that you can hold yourself to account. And you can evaluate at the end of the year. So decisions should be based on farm profitability, not just cost. So we want to look at the trade-offs because something can be expensive but can provide a level of coverage or some sort of return that may be beneficial for your operation. So let's not just focus on cost. Let's look at what it does to our operation in a variety of potential price and yield outcomes. We want to utilize crop insurance as a marketing tool. We talked about that. Crop insurance can be valued using similar methodology to valuing options. If we can bring that all into kind of one way to look at risk, it can allow us a simpler way to move through and understand how each element of risk impacts the different outcomes of price and yield. We want to choose the right tools for the situation. For those that were here in the last in the last presentation, we had TJ up here, who's the director of sales for finance. And one of the things that he focused on is making sure that you get out there and you make sure you do your planning early and you understand your working capital throughout the crop marketing year. Understanding the working capital availability is going to give you a better understanding about which tools are appropriate for you. And then finally, separating futures and basis decisions. Those should be independent decisions. They can be made at the same time, but we want to make sure that we're not doing one out of convenience. We're making decisions for the right reasons. Moving on to systematic and repeatable, we introduced this concept of percent hedged. And again, it's the common denominator across insurance, futures and options, cash contracts, and then OTC style contracts like accumulators. One thing I didn't touch on that I think is helpful is understanding these are our percent hedged recommendations actually last year. And so this is actually the maximum, like when we're thinking about risk management, as we move through time, we want to have an understanding about how much we want to be sold, what's the maximum, and what is the minimum amount that I want to sell at this time. If you have those rails established, you may be forced to get more hedged even when you're bullish. And that still can be a good decision because the market never asked any of us whether or not we're bullish or bearish. The market's going to do what the market's going to do. So it is important to understand that our bias doesn't mean it's going to absolutely happen. We understand that the market moves in mysterious ways, and it can't always be predicted. So we have to make sure we're being systematic about it. We have to make sure we have guardrails and we're being held to account. Finally, building an advisory team. I think that's important. That could be just key influencers, people that can help you, that understand your goals, understand how you're thinking about risk management, and can help you evaluate the different risk decisions through that crop marketing year. There's all sorts of different people can make an outstanding advisory team. And finally, evaluate and improve. Make time. At the end of the year, make time. Go back through what you planned. Go back through what you did and why. Understand, was this something that was in line with my crop marketing plan? How can I improve? So if you're not writing it down, you're not keeping track of it, it's really hard to go back through and evaluate your decisions. You can get caught in a cycle. So make time to evaluate at the end of the year. We talked about percent hedge. I'm going to pass it over. To Eric. I'm going to quickly skip over percent hedged. The one thing I will touch on is that percent hedged is it's the one risk metric that we absolutely want to be thinking about because it incorporates insurance, cash products, futures, and options. Percent sold is more of a cash terminology. It really has more to do with your delivery obligations than it does with your price exposure, your price exposure. Oops, sorry. And then finally, we want to make decisions based on farm profitability. And so we introduced this matrix. This matrix has price on the y-axis, and we have yield on the x-axis. And each of these combinations, if we've done our planning and we understand our cost of production, these have potential profitability and potential loss. And so this is just a specific example that just shows production without any sort of risk instruments overlaid on it. Moving on, I think this is where I'm going to pass it over to Eric, and he's going to talk about insurance and specifically model out what different products do to that matrix.
Thanks, Cody. So we're going to go through some highlighted strategies that have been spoken of here a little bit. We'll talk about just the base multi-peril coverage that most of you are used to taking. ECO and SCO, which are endorsements that fall under the multi-peril umbrella, and what those look like a little bit, maybe how those are used, whether those might be a fit for you or not. Margin protection, which the ship has sailed on. September 30th was the deadline for wrapping your 2023 margin protection up. But it's still good to talk about. We'll breeze over it. And then going through some sell and defend strategies, put spreads, and then three-way stuff, which I'm getting over my head being the crop insurance guy. I know enough to be dangerous, and that's about it. So that'll be up to these experts.
That's all, folks.
That's it. By the way, I noticed whether it's a school bus, church, or a meeting, it seems like the back row seats come at a premium. I wouldn't be any different, probably. All right. Yes, that's it. Thank you. Okay, so looking at the matrix, and we're going to look at this quite a bit, so I'm just going to warn you, you'll see several of these. We're going to move through them fairly quickly, and then I'm going to give you kind of the takeaway. Those of you past about row 6 aren't going to be able to see the finer print, and that's okay. Really focus more on the color, and like I say, I'll help you with the takeaway here on each one of these. So starting out, this is just a benchmark RP 75% policy. Okay, 75% of your approved yield times we're using a $6 projected price. The market's close to that right now, and so we're looking for 2023 corn futures, December corn futures. The premium on this, in our example, I believe it's an Illinois example, is about $7.50 per acre for enterprise units, 230 bushel approved yield, $6 price. With that 75% policy, whether you want to look at it protecting 75% of price, that's $4.50 where it starts triggering at the approved yield, or 172.5 bushels at the full projected price. A lot of times we're conditioned to think of crop insurance as just the yield side of it, but it's really revenue, which is the price and the yield together, combination of the two. It adds a 15% hedge at a 601 price. So when we talked about the hedge strategy earlier as a measurement across the board for all your risk management products, that's where we're at on this one. Okay, so this is simply looking at profit and loss scenarios and outcomes. On the left, you've got simply what we call just the acres, so your planted acres out there. And like Cody showed on the first one, you've got a lot of red in there without crop insurance. And so crop insurance on the right is just basically taking all that red away. We still do have some negative figures, but in the lower left, it gets no worse than $72 loss per acre, which still isn't great, but it's a lot better than $486 loss on the matrix on the left. So what if we said, you know what, let's get rid of the negative if possible. Can we do that? In this example, we can. As long as that $6 price hangs in there until March 1st. We're looking at an RP 85 policy on this one. And it's a $34 an acre premium, so it is more expensive. But as they say, you get what you pay for, and that's no different in crop insurance than it is a lot of things. So you can see, for instance, on a price, 85% of that $6 price at $5.10, or you could trigger at 195.5, which is 85% of the 230 approved yield, or a combination of the two. And where the RP75 was a 15% hedge figure, this bumps up over 27% hedge. Okay, so then when we compare the profit and loss scenarios of an RP85 with or without RP85, you can see all the red on the left we're used to, and then on the right, the negatives have gone away. So no more negative $72. Worst case scenario, it's now positive $39. So that's net of premium and other expenses. You bet.
Guys, this is really important here. As we're looking at this, we saw premium go up by 5 times. But for that 5 times increase in premium, we now have a profitable solution, right? And refocusing away from cost, particularly on crop insurance, can really mean the difference between having a solution that ends up working for you or a solution that was really more like a fire insurance policy where you just put it into the safe and hope that you never even had to look at it again.
Yeah. Thanks, Josh. Excellent points. That's one thing I like about working with the risk management advisors. We come at it from two different angles. So very much appreciate that. So you can see here just a simple RP75 on the left, the RP85 that we just looked at on the right, so you can see them together. Huge difference. Okay, SCO and ECO. These are close cousins of each other. These are both considered endorsements of a base policy. So you could have an RP policy like we just looked at, and then add this on top of it. What is it? It's an area-based or county-based product, okay? Some of you might say, what's that? I wouldn't want to buy a county-based product. I've always bought RP, and that's individually based on my outcomes and my APH. But if anybody's taken Ark County, you have taken an area product. Okay, Ark County is a county revenue policy. SCO, in fact, you are not eligible to buy a SCO endorsement if you're taking Ark County on the same acres. You cannot purchase SCO. However, ECO does not have that limitation. It's a March 15th sales closing in a lot of areas, but it really matches whatever your base policy is. So let's say you're a little further down south and your crop insurance sales closing date's the end of February. Well, then that's what it's going to be for SCO and ECO as well. That projected price then is figured in its normal cycle. It uses the same price as what your RP would use. And then it's basically a band of coverage. If you look at the chart on the right, it basically just shows a nice outlook here of the SCO coverage in the orange, and you've got the ECO coverage in the green. There we go. And it's just basically a band of this county revenue coverage. So what's nice about it, let's say that you say, well, I don't want to go all in an all county revenue policy. Maybe you don't feel comfortable with that, but I do want a higher level of coverage. This might be an option for you. It is available on a lot of crops in a lot of counties, and you want to check with your agent just to see where it's available for you. So SCO is going to cover, in this case with an RP75, from that 75% level, except it's switching over to county coverage for that band. So from 75% of the expected county yield up to 86%, that 11% band is what I'm covering for county revenue. Everything below it is still RP on your APH and your outcome. And then ECO will take it from there. So if you said, you know what, I want a more than 86% county revenue guarantee, you can purchase it. ECO offers a 90% level or a 95% level. Another clicker. Thank you. Okay, so this is just looking at a tool that we looked at the last hour, and basically we have an evaluator that looks back on SCO and ECO loss payment scenarios for all states and counties that those products are available in on the crops that they're available for. So what you're seeing in the blue is payments, in this example, crop and county, for Ark County. And you can see where it paid out 2014, 15, and 16 pretty well. And then you've got in the orange the SCO, and then you've got in the green various levels of the ECO. So the band from 86 to 90, and then the darker green band from the 90 to the 95%. And so it's interesting because sometimes Ark and SCO and ECO will pay, and that's what causes the limitation in eligibility for SCO. They don't want you taking Ark and SCO at the same time. One thing you'll notice is Ark hasn't paid for a while in this example, and that's not going to be true in every case, but it's true in a lot of cases now. And the main reason it has to do with, without getting too deep on Ark, is Ark uses a 5-year Olympic average for the benchmark prices. And so right now that's not favoring Ark. It's clawing back on what's some low prices in a lot of cases on a lot of commodities. That's why it looks so good in 2014, 15, and 16 right out the gates, because you were clawing back on historically high prices at that time. So you really had inflated guarantees as a result. Okay, here's a little matrix on the ECO, 95% level. It is expensive in this case, $44 an acre premium just for the ECO, okay, at a $6 projected price. And then these are all net values. So if you can see it, if you're sitting far enough in this room to see the $44 premium, you'll see that up in the orange, upper right. And then the lower left is showing $80. And so these are net outcomes, right? So if you fall into that range of prices and yields, you're going to net $80 an acre on just the ECO endorsement in this case. So the indemnity in this case starts at $5.70 from a price standpoint with a $6 projected price. So it'd only have to drop 30 cents to start triggering if the expected county yield didn't change from its average, okay? Or alternatively, if we looked at 95% of that 212 county yield, so that's 201.4, any county yield below that at a $6 projected price would start to trigger a loss as well. And you can see percent hedge, even though it's just an upper band of coverage, it's still adding over 10% hedge at that 601 price. Right here is a little bit more of a, just adding the RP85 underneath it, because we do need to buy a base policy. So we just isolated ECO on the last slide. Now we're actually showing the full package. So you do have a lot of premium wrapped up into it. But like Josh points out, if you focus on the cost, sometimes it'll prevent you from making a good decision. And that's hard to see, but that's one thing I like about the Matrix tool is it helps you see all those outcomes more than just seeing a quote. You're actually seeing what are the potential outcomes here and the potential benefits. So you can see there's a lot of green down the lower left and then up in the upper right, which honestly would be a great cash position if you had on the extreme 290 bushel yields with 937 price. So probably pretty unrealistic, but you know, some premium. And by the way, that was a 38% hedge. Okay, so here it looks like we're missing one of the matrices. But this is supposed to be showing basically back to the standard, no insurance on the left, and then ECO 95 with RP 85 on the right. Okay, we're missing a couple matrices here. Sorry about that.
Well, what you would see if the image was there is you would see down below where you're seeing all those $39 profit levels, you'd actually be seeing $120 per acre of profit. So by spending an additional $44 to generate an additional $80 of indemnity to the downside, we've continued to move up the profitability food chain from at RP 75, this negative $72 worst case outcome, up to this $40 outcome for RP 85. But with that ECO policy, in this case, assuming that $6 projected price, guaranteeing ourselves about $120 per acre. And $120 per acre works. All right? Am I right?
It's a pretty good worst case scenario.
Yeah.
And thanks, Josh, for being able to fill in for the missing matrix. He is the matrix. Margin protection. So graphic on the right, any of you that have taken margin protection, just bear with us here. But on the right, basically, you can go all the way to 95% of the expected county yield if you like, and then all the way down to, I think, 70% is the bottom level, 5% increments in between. So just seeing that graphically against an RP 75, let's face it, you know, it's nice to, the good news right now is market prices are pretty high historically, but also expenses are pretty high. And so we've just pushed that margin higher and higher from a percentage standpoint. And so some places 95% or 75% doesn't get it done, you know, as far as when your parachute needs to come out. And so some of these higher levels, whether it's SCO, ECO, or margin protection, can kind of come in and work pretty solid. Margin protection, by the way, since it was already set and you had to purchase it this past September 30th for the 2023 year, the price on it for corn was $6.11, which looks pretty good right now. Okay, here's the profit loss. So again, no coverage on the left, and then 95% HPO with 120% protection factor. What does that mean? It means that you can take a range of 80% of the protection that would be generated from a 95% MP policy at the projected price. So you can take 80% of that all the way up to 120% or anywhere in between. And all that does is simply controls the cost and the coverage for you. If you like it, but you don't like so much of it, you can throttle that down. If you like it and you want as much as you can get, you can throttle all the way up to 120%. That's what the right matrix is showing. And those are some pretty positive values there. If you look at the green boxes, that's really kind of the area of expectation, right? We're worried about prices going down. We're worried about lower yields.
Does anybody have any guesses why the USDA and the RMA would allow us to buy 120% protection factor? Right? They're essentially allowing us to insure crops that we don't even have. Right? Well, one of the problems with county insurance is that you might have a loss when the county doesn't. Right? So in order to increase adoption of county policies, they allowed producers initially in the GRIP policy. I don't know how many of you guys ever heard about the GRIP policy a long time ago, GRP and GRIP. But this is something that they're still bringing in with the margin protection policy, essentially allowing us to have an even greater amount of coverage. This is really powerful for folks that are looking for a lot of coverage, and a county policy really kind of works for you. Thinking back to why, right, they're allowing us to do this thing, that when we look at the matrix, right, we're guaranteing ourselves nearly $170 an acre of profit in a situation where that's going to look really good for us.
Absolutely. Thanks, Josh. Appreciate that explanation. Okay, well, we know what the left one is. We'll go ahead and skip through this one here. Okay, so thanks for bearing with us on all those matrix slides. Takeaways, know your options. That's part of, like we said in the first session, making a plan and making sure that you share the right information with the right advisors on your team so that they can give you the right feedback and help you build that plan. And then kind of understand where you're at, where your starting point is and kind of where you'd like to finish and what steps need to be taken in between as the opportunities arise in the market. And then just being proactive at that point. It's human nature for any of us to kind of wait until the last minute, and crop insurance is no exception. I bet everybody in here knows what the crop insurance deadline is, and I usually like to make an appointment about 48 hours in advance of that deadline. And I understand why. You want to have as much information as you can, and that's not always a fun decision to make. And so sometimes we think, let's just wait till the last minute. But even though you don't have to pull the trigger until closer to that sales closing date, I would encourage you to meet with your agent, talk with your agent well in advance, and just find out, is there anything new? Is there anything changing? Is there something I need to be paying attention to? And then likewise, if you made a change in your operation, maybe you're adding land, deleting farms. Sometimes farms get traded, in family situations, split up and whatnot. Share that stuff just to find out, is there something I need to be aware of here? I've seen situations through the years where somebody says, hey, does it matter I created a new corporation? Like, yeah, it usually does matter when it comes to crop insurance, so let's talk about that. So definitely be proactive on the whole plan. And then just to focus on farm profitability, like Josh alluded to, it's easy. Cost is an easy thing to see. Premium cost on insurance is really money you're throwing out the window that you can live with to cover risks that you can't live with at the end of the day. And so just making sure that we focus on not just what the cost is, but what's the outcome? What am I getting for it? And then optimizing to your farm's operation. A lot of times people say, well, what's everybody doing? And it really doesn't matter what everybody's doing because maybe they're not doing the right thing. Or maybe they're not doing the right thing for your operation. And many times that's the case because everybody looks at things differently. Everybody's financial position's different. There's a lot of different options for a reason, and definitely take advantage of them for you. And then the area coverages that we talked about, like margin protection, SEO and ECO, aren't a fit for everybody. But I'll tell you what, I have a feeling they're a fit for a lot more people than what you might think. And so just, it's kind of like one of those things, turn over every stone, make sure that you look at it and give it a good, solid look for your operation, just to make sure that maybe it doesn't work for you. Okay, back to Cody.
Yeah. All right, we'll move. Okay, so back to crop marketing. I'll just touch on this one last time. So systematic and repeatable, decisions based on farm profitability, and I think Eric did a great job showing that the wide variety of outcomes of price and yield, and trying to better understand what does this coverage do to my risk situation in all of these outcomes. And then, it's easier when you're closer to the paper. You can see the numbers, and it really helps you understand what you're buying, what you're purchasing, and how it's working for you. And then the other thing is that matrix can get updated. It can get updated as you move through time, as prices change, and as your expectations for production change. So that's great now, for our projections, but then we have, how's the growing season going? What are market prices doing? And we can have that all updated very regularly. And it can be very powerful in making the next decisions. The next decisions, which may include using, cash contracts or futures and options or some other type of over-the-counter. So these were some great quotes here. Everyone must choose one of two pains: the pains of discipline or the pain of regret. And then just to bring it back to Jacko, if you allow the status quo to persist, you can't expect to improve performance, and you can't expect to win. So I think these are two great quotes. The first one is be disciplined. Be disciplined, get your plan out, be disciplined about it. And there's times when you're going to need to make sales even when you are bullish, because we don't know where prices are going to go. We don't know what weather's going to do. We don't know what Russia's going to do. There's things that we just don't know, and we're going to have to be, persistent about maintaining discipline. So sell and defend. So we were thinking about the strategy. What are the strategies that we think are going to be important this year? And I got two strategies up here which are very similar to each other, and they accomplish one very key element when we think about the principles of crop marketing and brokerage. Sell and defend. So selling and defending means making a physical cash sale and then re-owning, defending, a possible move to the upside by re-owning a call. Okay, it's a simple strategy. It's a simple strategy that does a couple of things for us. First, we get more percent hedged. We get more percent hedged because we made a cash sale. We've set the futures in the cash market in our cash contract. But we had the confidence to do that because we were able to purchase a call. Now, a call is the right, but not the obligation, to own a future at or above at a specific price, by a set period of time. So it gives you exposure to the upside, allowing you to participate if the market continues to rally. But it allows you, and oftentimes it gives you the confidence to stay in plan. And I think that's important. I mean, this is a simple strategy. It's not fancy, but it allows you to have discipline. And the nice thing is, I mean, this strategy right here, it's best used when you're kind of in the middle of the growing season, when you're getting more comfortable about your crop being made. It can be really effective after harvest. You want to stay in the market. You think it's going to move higher. It allows you to make a cash sale, deliver on that crop, get the cash flow moving, and then stay with some, skin in the game for potential upside movements. It's a little bit, there's some trade-offs if you use it too early in the season, before maybe even before you're putting the crop in the ground, because you're making a cash sale, and once you make that cash sale, you have a delivery obligation, and you may run into a situation where you have some hard yields or crop loss, and now you have to negotiate out of a cash contract. That's a lot harder to do in the cash market than it is when you're using futures and options. In futures and options, you just exit the position. Of course, there could be potential P&L. There's going to be a profit or a loss on that position, but the point is you can get out without fees or something else. So there's trade-offs to this, but the key part of this strategy is it gives you the confidence to get more hedged, even when you think maybe the prices could move higher. So I'm actually going to kind of skip over some of these because we're running out of some time, and I want to talk about a put to use to hedge. So we talked about sell and defend. That's a cash sale and re-owning a call. A put is really the equivalent when you think about percent hedged. A put is going to give you protection. A put is the right to sell, the right, not the obligation, to sell a future at a specific price. And so the nice thing is there's no margin risk in this particular scenario. The downside is it's going to cost a little bit more. It's really similar to an insurance policy if you're using a long put or you purchased a put. But again, a put is going to give you confidence. It gets you more hedged. And a put can be more effective earlier on in the crop season when you're less comfortable with your overall production. So I just wanted those two strategies, super simple. But I tell you, this year, when we have higher prices, there really is no better time to really start to add discipline and spreading out your sales. Because eventually, the market can go up and it can go down. Past performance is not indicative of future results. But eventually, it's likely that we'll revert to the mean. And in those years, you are not rewarded for waiting on your decision. In those years, there's real risk on the line. So we think defending profitability, if your break-even shows one, we think defending profitability in these sort of years, even though fundamentally we're slightly bullish for corn. Fundamentally, we're slightly bullish, but these are times to really get those tools in place to defend these levels. I'm going to pass it over to Josh to talk more about some other strategies, put spreads, and the three-way option strategy.
All right. Thanks, Cody. So we're looking here still at put spreads. And one thing that we're looking at puts here to start off with is we're looking at a 100% put strategy, right? This is not something that we would normally recommend to folks, but we're doing this just so that we can emphasize exactly what this is doing for us. So this put spread on a 100% gives us about a 50% hedge. However, to get that 50% hedge and to get that 100% coverage to the downside, it's going to cost us $107 per acre. Now, if you remember from Eric's slides, the highest cost that they were looking at was about $76 per acre to get similar coverage, although a little bit lower. When we marry these together, we see that put hedge does a great job to the downside. It's really kind of guaranteeing ourselves no worse than about $25 per acre, worse than where we're at right now, but it's cost just an absolutely ton of money. This is where put spreads come in. So when we're using a put spread, we're both buying a put and we're selling a put. Can I get a little show of hands? How many people, first of all, have used options at all? Okay, so quite a few people have used some options. How many of you have bought an option? Bought a put, bought a call, okay? And how many of you have sold an option. Sold a call, sold a put. Okay, so it's pretty similar numbers. The folks that have, right, I don't know if you guys can see this, but the folks that have bought have also, for the most part, sold as well. So when we're selling a put, in this case, we're selling a covered put, right? Which is to say that we're selling a put further out of the money than a put that we've already purchased. This is a limited risk scenario. So this has no margin risk. We only have the risk of the premium that we're putting out there for this. This is cheaper than an outright put because we're selling that right, without the obligation, away below a certain point. This gives us a band of price protection to the downside while still allowing us to retain exposure to those higher prices. And again, versus a cash sale, it's easy to trade out of. The con of this versus a put is that it has less immediate traction. On the long term, right, once we have time decay in there, it has plenty of traction. But if we were to say break $1 over the next month or the next 2 months, we're going to see a significant lag in terms of the final outcome versus what we would have perhaps seen with a put outright. It needs time to work well. So instead of looking at protection all the way to the downside, we're really kind of just limiting ourselves to the area on the chart where we can see this green box. Now, when we take a look at this green box, we see that it actually kind of covers the likely risk that we're going to have. So in this case, this put spread is buying an at-the-money put at $6, and then we're selling a put below at $5. Right? Again, we're doing this on a 100% just to demonstrate exactly what this is doing for us. We're saving ourselves about 25% of the cost that we were seeing previously on the put only spread. However, this is lowering our spot hedge, our spot percent hedged, from being 50% hedged to only being 28.1% hedged. So still not necessarily the best outcome that we would want. Over on the right-hand side here, we see the put only, and on the left side, we're seeing the put spread. We're seeing the put spread to the outcome, and here we have that same profitability view, the payout view, and we're seeing that to the downside, we have, with a put, we have full coverage, but with a put spread, it's costing us less, but it stops working right around $5. It's really moving fast now. Okay, so put spreads. Why put spreads this year? Well, there's something that has been happening over the past couple years, which is that we've seen volatility higher. Now, volatility is not something that a lot of folks talk about or think about when it comes to options, but there's another term for volatility. Of all of the factors that go into the price of an option, there's one X factor, and that X factor is volatility. This is the price of risk. This is how much they're actually charging us for this risk. And what we've seen is that in 2020, it started to go up from where it was, really kind of spiked last year, but this year we're still higher than we have been any of the past 7 years. So when we have that high volatility, that means that those puts that are near the money are going to be really expensive. But it also means that there's an opportunity to sell away that volatility on the wings to lower our costs.
Let's quickly go back to that. So I wanted to explain this comparison. So this looks at the same put, the same days till expiration. It's a $6 put. And I'm just showing you the difference between when you have a 15.9 volatility versus a 22.14. And you can see, and I did 22.14 because that was exactly the vol in these options when I built this slide. But you can see premiums 51 cents. If you contract that vol down to 15.9, then it's a 37-cent option. And so I just wanted to explain what that volatility, volatility is living. It changes. It moves higher. It moves lower. These are things that Josh and the rest of our team, we're paying very close attention to. And it helps us to choose the right tools at the right time. And so, volatility is important, and you can see in the graph to the right here that volatility has picked up over the last couple of years, creating a situation where just options are more expensive. So we want to really refine to create the most efficient hedging package that we can.
Thank you, Cody. The last strategy that we're going to be talking about is a three-way, right? So we're building on that put spread strategy that we just had, and we're adding in a sold call, right? What is selling a call actually doing for us? Anybody in the audience, what does a sold call do for us in terms of marketing? Anybody? Puts a ceiling on it. That's exactly right. It obligates us to make a sale, right? Now, we can trade out of that still. We can very easily trade out of that. But it obligates us to sell away our ability to continue to be long, right? So this makes it cheaper than that put spread because we're monetizing that right to be long above some level. Right? So this gives us a band of protection to the downside, and it gives us a band of upside from where we're at without all of the upside. Right? So we're going to still retain just some of that. We're still retaining our optionality, and it's still easy to trade out of. It has less upside than that put spread, but we're going to see substantially lower costs. So here we're looking at this payout of just our put spread versus a call. And instead of looking at $107 per acre for just the put or $83 per acre for our put spread, we're now down to $35 per acre. And again, this is on 100% of production. This has really trimmed down the cost of what this strategy might cost. And now to the downside, we're generating $180 of potential benefit because we've lowered the cost of that put spread by selling that call away up above the market, at this case at $7. And now we still have that nearly 50% hedge. Here we're comparing the two between the put spreads versus the call. So we're about $50 better to the downside. That's directly reflective of lowering that spot cost today. And here we see we really have not actually given away that much that much spot cost. From where we were at, about $280 of profit, we're still around $247. And we really kind of maintain that all the way down to $5. Well, what's going to happen around $5? Well, we're going to talk to Eric or one of his agents, and we're going to have some crop insurance down there. Put spreads versus calls marry very well with a crop insurance policy. The key is understanding the interplay between both of them. If we can understand how crop insurance is working for us, if we can understand how our option package is working for us, we can make the best, most informed decision and make the decision ultimately that we were hoping to make in the first place. So just to review our strategies, we started off here with our base MPCI strategies. This is risk management at wholesale. We added on some ECO and SCO. These are additional coverage options that allow us to get cheaper coverage up to 95% on top of our MPCI. We reviewed the margin protection option that this year was fantastic. It really enabled us to secure a very high level of coverage to the downside. And then we took a look through the various options that we could look at, puts or functionally a synthetic put, selling grain, buying call on top of it, put spreads, and then a three-way. There's got to be some questions out there. Who's got some questions? Got about 5 minutes of questions.
How do you come up with the percent hedged on each of those strategies that you had with the crop insurance there at the bottom?
Great question. So the percent hedged methodology is bringing option theory to crop insurance. So when we're thinking about an option, when we're thinking about a put, an at-the-money put is going to have 50% coverage. When we start moving that put down, it's going to have 40%, 30%, 25% coverage to the downside. Right? We move it into the money, it's going to go greater than 50%, 60%, 70%. Crop insurance isn't like that. Crop insurance is an on or off situation. So when we have a $6 projected price, and let's actually kind of move all the way back. Can we keep on going back a little bit more? I think the batteries are about dead on this thing. When we're in a situation where, that one, no. Anyway, when we're in a situation where we have a $6 projected price, everywhere below our guarantee and below that projected price where we don't have an indemnity, crop insurance is doing nothing for us. The effective risk of that crop insurance is at 0. Once we generate an indemnity, we're now 100% risk managed at that point. We have a guarantee. The price cannot get any worse than that. The only way for that crop insurance to manage that risk is by selling away our bushels. So if we're producing 200,000, 300,000 bushels, our crop insurance is getting us short 200 or 300,000 bushels. Up in the upper right-hand corner, it actually gets us long, right? So if we have a yield loss, it's actually buying us those bushels back, right? As long as we have that harvest revenue option. So to answer your question, how that percent hedged works for crop insurance, what we're doing is we're taking that center point and we're assuming that that has the highest likelihood of occurring. Why? Because that's where we're at. It's at 100%. For every cell that's around that, we're evaluating each one of those cells, and we're going to average all of those cells at a slightly lower weighting. And we're going to continue to do that in concentric rings all the way out, so that at the end of the day, we'll have a blended weighted average for every single one of these cells that gives us a percent hedged, so that we can meet the two risk management instruments and blend them together so that we can understand them together. Great question. One more question. I think we have time for one more question.
Within your matrix there, can you overlap the options hedging strategies with the different crop insurance?
100%. Great question. So the idea behind the matrix is that we want to match everything that you're doing for risk management. Well, what are some other things you can be doing for risk management? Well, maybe you have a seed corn contract. Well, that seed corn contract is going to guarantee you a certain number of bushels, right? You've just got to produce whatever they told you to produce, and it's going to guarantee you a whole bunch of bushels, right? When you sell that seed corn contract, you're going to be selling at a percentage, right? Well, that's all risk management. That is something that the seed corn company is going to help you risk manage that. We're going to take that into account. We're going to put that into the matrix. We have puts, there's calls, there's crop insurance. Each one of these layers on so that we're evaluating for you guys everything that you're doing. Additionally, something that we have not talked about in here really yet is OTCs. OTCs, very few people can show exactly what it's doing for you because it's a strip of options, right? It's actually puts that are expiring either every day or every week and generating a final futures price for you. Well, how does that actually work? We have a system on the backside that is actually doing all of those accumulations so that you know how some min-max accumulator or some premium capture accumulator is actually working for you. And we're going to build all of those things together for you so that you can see ultimately everything that you guys have for you.
Yeah, and we're running out of time. So I think one of the things that is important here, there's probably questions that you have. We're going to be at the trade show. I'm going to be down at the crop marketing booth. Josh will be down at the crop marketing booth. Eric is right next to the crop marketing booth and the insurance booth. So we're right next to each other. And I am extending the invitation. Swing by, bring your question that you may pop up to you in 30 minutes or an hour tonight. Stop by, talk to us about it. Be happy to answer some questions. But we're 1 minute away here, so I think we'll shut it down. But please do stop by the booth and talk to us. We'd be happy to answer any questions that you have.
Thank you, everybody, so much. You guys have been great. Give yourself a big hand.